Well, good afternoon, everybody. It is now officially the afternoon. I am Lee Schwartz, Director of Business Development here at SVA Certified Public Accountants, and I'd like to welcome you to today's nonprofit business briefing. This one is titled Reading Between the Lines, Interpreting Nonprofit Financial Statements. So today's session is designed to go beyond simply understanding what financial statements are and really focus on how nonprofit leaders, executives, and board members can use them as strategic tools to make stronger decisions, identify trends, and spot risks before they become operational problems. Now, before we get started, I just want to take a quick moment and say a few words about SVA and our work with nonprofit organizations. So SVA has been serving organizations for more than 50 years. We were founded in 1974, and nonprofits have always been an important part of that history. We work with organizations of all sizes across Wisconsin, Colorado, where we have an office now, and really throughout the country. We help them with audit and assurance, with tax compliance, outsourced accounting and controller services, advisory services, and board education. But one thing that makes SVA really unique is that we remain an independent firm. So while many firms in our industry have merged or taken pretty sizable investments from private equity, our focus continues to be on long-term relationships, personalized service, and helping organizations serve their missions more effectively. We think remaining independent and local aligns perfectly with the missions of nonprofits. Now, as you listen today, please feel free to submit questions as we go. We are going to try and save time at the end for them. And if we don't get to your question live, either Kirsten or myself will try to reach out afterwards with either a follow-up or an answer. But without further ado, I want to introduce our presenter today. Many of you already know her, but it's always my pleasure to introduce her because it is Kirsten Houghton, and she is a principal here, has been for a long time, and she is the longtime leader of our nonprofit services group. She works with nonprofits, as I said, of all sizes and scopes, across a wide range of areas, including audit, tax, governance consulting, strategic planning, financial oversight, you name it, she's probably touched it. So Kirsten, I know we have a lot to talk about here, a lot of ground to cover. I'm going to turn it over to you.
All right, thank you, Lee. And thank you everyone for joining us. I appreciate you signing up for the webinar. And if you're somebody who's listens to me afterwards because you couldn't quite make it today, welcome to you as well. So a little history behind this. If some of you have attended last winter, I did a nonprofit financial statement webinar talking about the basics. So we were kind of brainstorming on what we should do for 2026. So we talked about, let's talk about how these statements work together and giving more understanding behind what's going on in those financial statements, because it can be confusing. And what's always really unique to nonprofit organizations is that you are all different. So even though you may have similarities between organizations, you all have a different mission and goals. You're operating with different groups of people, whether that's your stakeholders or the people that you serve. So there's lots of unique things that go on, but there are commonalities between financial statements that I'll go through. One thing too, we'll also have in here are polls, just for us to understand more of where you struggle or where you feel confident in what you're looking at as far as financial statements go. And again, focusing on nonprofit financial statements, which are different than for-profit financial statements, and we'll talk about that as well. So our objectives we have listed here, we're going to connect the four statements. And when I say the four statements, it's the statement of financial position, the statement of activities, the statement of functional expenses, and the statement of cash flows. And we'll talk through each of those, what we're looking at when we look at each one, what's unique about them, how you spot trends and risks within those financial statements, and how they can be used to strengthen your governance, so that through your board of directors, so they understand what they're looking at. You're making sure they're looking at timely information, and then allows them to ask better questions. So we're going to go through all of that. One thing we're going to do first, like I said, is we'll have a poll question. So we're going to run that now. And the question is, how confident are you in reading nonprofit financial statements? Very confident, somewhat confident, neutral, slightly overwhelmed, very overwhelmed. We'll just add another one, not sure at all. And we'll see what those answers are. We'll let that run just for a minute. while we're waiting, we'll talk more too. We'll go why into financial literacy matters so much for nonprofit organizations, not only for management, but for also the board as well. And I think our results are going to come up. So looks like most people are somewhat confident with some neutrals and a lot of very confident. So it feels like about 25% of you maybe are overwhelmed to a bit or maybe a lot. And the rest of you are fairly confident in what you're looking at, which is great to hear. But for those of you who are overwhelmed, I hope what I'm going to tell you today helps, and that those of you that feel more confident, what I tell you today actually enhances your knowledge. So we'll talk about why financial statement literacy matters. It matters a great deal. Unfortunately, I've attended board meetings or been involved with clients. I've been working with nonprofit clients, I think, since 1999. My first CPA position in Madison was in 1997, where I did individual tax returns for 2 years, which I knew was not going to be a long-term thing for me. That was not my thing, but I was able to start working in the nonprofit industry in 1999 and been doing it ever since, and I've loved it. But I've seen a lot of things over the years, and one of the things I've seen is financial statements that aren't up to date. So the board may think they're looking at complete financial statements when actually there's entries that aren't there, and that typically is not found out until the audit comes around and we have many journal entries. So what ends up happening is that your board is looking at financial information that's not up to date and accurate and making decisions off that information. So that's why that's important, that they know that they're looking at up to date information. The board's responsibility, one of the things of board governance is a fiduciary responsibility to make sure that they understand what they're looking at and what it means. And I know we'll have people join boards that are very passionate about your mission and may not have a lot of financial background. So it's really important that they're educated, whether that's through board orientation or a specific training that you hire someone to do, so that your board is very aware of what those financial statements are telling them. And that goes to, of course, not just beyond the accounting department, so internally as well with management. You know, depending on how large you are, that could be a number of people. If you're a small organization, that could just be your executive director. Also, transparency is very important. The donors and the grantors who look at your financial statements and also your Form 990 are looking for accountability, transparency, understanding. One of the things I think that provides a lot of transparency in the financial statements that we'll talk about later are the footnotes to the financial statements, because they give the user of the financial statements a lot of information about what goes on behind those numbers that they see on the individual statements. Also, mission continuity. Obviously, we all want to stay in business and you want to continue to serve the people that you serve, be able to have those funds coming in so programming can continue, maybe even expand. We've seen lots of changes in programming and need, and we know need is probably higher than ever right now in many different areas based on just the economy and things that are going on. And it's really important that those missions continue and the funding is there. And then finally, financial warning signs often appear in the financial statements before in operations. Things that I see are when a financial statement has a lot of non-liquid assets, so not a lot of cash to pay for the expenses. That's one thing that comes out, but I'll go into that in a lot greater detail as we move through the statements. So we'll talk about the 4 financial statements. So the first is the statement of financial position. So this is a financial condition at a point in time. So meaning as of, if you're a December year end, it's as of December 31st, 2020, whatever it is. If you're doing these financials monthly, which you should be, you should always have a statement of financial position at the end of every month. And then statement of activities are your annual operating performance. So really it's your revenues less expenses. Do you have a surplus? Do you have a deficit? That can be annual. It can be monthly, it can be year to date, quarterly, whatever it may be, but it's looking at what is happening with operations as we're going through our fiscal or calendar year. Typically, too, you'll also look at comparisons of activities to budget as well. The functional expense statement, that supports the statement of activities. So on your statement of activities, that's where you're showing consolidated amounts for program service activities, management in general, and fundraising. So the statement of functional expense, which actually came into as a required statement for those of us doing your audit reviewed financial statements or compilations, that's now a required statement in that engagement. That gives you the underlying dollars behind each large number reported on the statement of activity. So it gives the users of the financials a lot more information. And then finally, the statement of cash flows, which is a statement that can be confusing. and is a little hard to even to describe what's going on because of it's a unique statement. We'll go into that, but it does show you liquidity and cash flow. And really what you're looking at is if you have positive cash flow at the end of the year or is it negative?
Kirsten, can I jump in and ask a question?
Sure.
So you mentioned on the previous slide that the first part was about the board's fiduciary
Right.
responsibility. I know we talked to nonprofits that have much differently structured boards. Some are a little bit more experienced with the financial aspect. Some are more development boards. Just from your experience, when you look at how the four financial statements work together and anything else the board would be looking at, what are like those areas you typically see maybe are weaknesses of a board member's understanding of the financial statements?
Right. So with nonprofit financial statements, there are differences. I've been in situations where the board is kind of a lot of bankers, and they look at things like return on investment and taxes and different metrics than what a nonprofit organization would focus on. So there is that, and understanding that there isn't the profit motive. There's absolutely no problem with, and there should be a strong, healthy surplus to keep funding future operations, but there's not that typical profit that then goes to owners and things like that. And so there's differences there. And then also, too, one piece of accounting that I'll mention several times in this presentation is just how contributions are treated for nonprofit organizations. That when a contribution is committed, it's recorded as revenue, even though it might be a multi-year grant that they'll get over 5 years. They have to recognize all the revenue in the year that grant or contribution is committed. So there's different things like that that go on, and that's why you really need to assess of your board members what their experience is. Do they understand nonprofit financials? And they may understand the bulk of it, but just kind of those areas need to be explained in further detail. Because a lot of the nonprofit financial statements are no different than for-profit in the sense that you'll have accounts payable and liabilities for payroll. You'll have a cash account. Maybe you have property, plant, and equipment because you own your own building and you've got your own equipment and all that kind of stuff. So, but there are some differences that they should be aware of.
Yeah. Thank you. I know we've got a lot
Sure.
of board members on right now, so
Okay.
I figured that would be good. Anyway, continue. Sorry to interrupt.
No, you're fine. All right, so statement of financial position. So as I said, this is a measurement as of a point in time. So whether that's the end of a month, a quarter, looking at it through the annual audit, and maybe that's for some of you, that's all you see. So it provides insight into liquidity, debt obligations, reserves, long-term sustainability. So how does it do that? Liquidity is your cash and cash equivalents, and it can also be your receivables if management expects to receive those or receive the receipts, so to speak, within the year or pretty regularly. If you have receivables that are long-term in nature, say you're getting multi-year grants, so you're getting someone that may have committed $500,000, however, they're going to give it to you over 5 years. You've got that nice receivable balance, but yet that doesn't really help out with liquidity. That's going to help you year after year bringing cash in, but it may not hinder you, but limit what you can do currently because you don't have that actual cash. Some nonprofits have debt, some don't have any debt, but most have lease obligations, which is something that is recorded on your books. And if you have debt, that's something that's also a point in time, whatever that balance is in at the end. Reserves can be on the statement of financial position. Reserves either required by maybe a regulatory agency, by a grant, or that your board has set aside or management has set aside for the future, for future years use, or just even like for a cushion, so to speak. So one of the things that's unique to nonprofit financial statements are net assets, and those are net assets with and without restrictions. So without restrictions are the old unrestricted net assets. Those are the dollars that are available at the end of subtracting assets minus liabilities. You have net assets. If they're all without restrictions, that means that dollar amount's available to support day-to-day operations. So in other words, what you want to see is that your assets exceed your liabilities. You may also have net assets with restrictions. That is when a donor or a grantor gives you a contribution or a grant and says, hey, I want you to use this. I want you to use this in the next 5 years equally. So let's say it's $100,000. You're going to spend $20,000 a year, or I want you to use it over time, plus for this specific reason, for a specific program. So restrictions can be time or purpose or both. And that's something that really needs to be tracked and taken care of because above all, you have to honor your donor's requests. they become very upset when you don't do that. So it's very important to make sure you're tracking that. Another thing in the statement of financial position that gives a lot of flexibility to the board of directors are board designated reserves. So a board as a whole can vote to designate reserves, set aside money for either a long-term type of look into we want a certain dollar amount available for future use, or even just for something that's coming up, they can set aside money. They can also move money out of operating cash physically into a separate account. I see a lot of organizations where operating cash is kind of a catch-all for all the cash, and sometimes it makes sense to move dollars out of there. So with that, we'll move on to things to monitor with this. Oh, we have another poll, my mistake. So another poll. I blew right by that. Okay, poll question. What balances on the statement of financial position are a concern for your organization? Is it cash flow, liquidity, debt obligations, declining net assets without restrictions, receivables and the subsequent collections, restricted funds, or investment volatility? We actually haven't, I'll talk about investment volatility right now since we haven't talked about that yet. That's really looking at, for those of you that do have investments and that they're managed obviously by most likely a third party, and then you may have a finance or investment committee made up of some of your board members. It's always important to keep a good pulse or knowledge on that of what's going on so that when the market's good, you know you've got balances going up. When it's going down, things are going down. So it depends on what your reliance is on those funds. It may not have that much of an impact on you, but it may, depending on what you're doing. Many of our private foundation clients, their entire asset structure is investments because they're just granting money to different organizations in the community. And I think our results are going to pop up. So most of you are concerned with cash flow and liquidity, which completely makes sense to me. And then related to that is declining net assets without restrictions, because if your cash flow is struggling, those net assets are struggling too. I know receivables can be tricky as well as far as collections go. So it looks like a mix, but overall cash flow and liquidity is your main concern. Okay, so with that, we'll talk about key indicators to monitor. So liquidity right off the bat. Looking at current ratio trends over time, you can look at liquidity ratios. There's the current ratio, which is current assets divided by current liabilities. So it's the ability to meet your long-term obligations. So in other words, you don't want your assets basically kind of equaling what you owe. You want to have more assets than what you owe for sustainability over long term. So that's something to always look at. You're also looking at what is liquid on your statement of financial position. So if you look at your asset side, that's your cash and cash equivalents. It is your, most likely your receivables, given that they're not primarily long-term receivables, and then your investments as well, unless you have some dollars of that investment component reserved. And looking at all those dollars and saying, do we have enough here? How many times can we pay our liabilities? So for liquidity, if your balances are say $500,000, your liabilities are $250,000 on say an annual basis, well then you know basically you can pay those over 2 times. Same thing with months of cash. How many months of cash do you have available? Does the cash balance support 6 months of expenses, 1 month, a year? What does that support? That's important to look at too. Some of you had brought up net asset trends. So net assets, looking at those net assets without restrictions, is that declining because people are giving you more and more restricted dollars? And so you've got net assets without restrictions that's very robust, but the ones with restrictions is very robust, but the without is not. So that's something to look at a trend time over time. Debt obligations, for those of you that have those, looking at the balances and the terms and making sure you're in compliance. Collectability of receivables and pledges, that's very important to monitor. And if you have somebody that's slow to be sending in what they committed to you, making sure you're in contact with them and collecting those dollars. And then looking at concentration risk, which also comes into play when we get to the statement of activities, but looking at your dependence on investments and endowments. Are you highly dependent on what that investment account does? Or if you have an endowment and you're looking for payouts from those vehicles, are you really focused in on those and are really dependent on them? Something to look at as well. Red flags we can talk about related to this. As we've talked about already, declining net assets without restrictions over multiple years. That's showing that cash is declining, Commitments to the organization is probably declining. Contribution to revenue is probably declining. So lots of things. These are the red flags, warning signs that are happening while the organization itself, from an operations standpoint, might be just humming along. And this is what can be happening in the financials. Increasing reliance on lines of credit or short-term debt. When we see lines of credit that are maxed out, that's always concerning to us. When it's constantly at the max and it gets paid down a little bit, then goes right back to the max, we know there's trouble brewing there. Growing liabilities without operational growth. So your organization is stagnant, but the liabilities keep increasing, which probably most likely is a cash flow problem again. Negative working capital, meaning that you are not generating surpluses to support the organization and continue your work. Very large or aging receivable balances, meaning collections are a problem. And then cash balances are dominated by donor restrictions, so that the majority of your cash is tied up on purpose or time restrictions and isn't available to you to spend for current operations. Okay, so questions your board should ask. So your board are looking at the financial statements that you're generating and they're at the meeting. One of the questions they should ask is how much cash is truly available for operations. So you should be able to answer that question that you know. So for example, your operations, say it's $500,000 a year, your operations. I'm trying to make up easy numbers. It could be any number. And do you have enough cash that comes in throughout the year to keep paying for those expenses? That's something that they'll want to ask you. And then if you're maintaining reserves or a robust cash balance, how many months do you have to pay expenses? Or are you on a razor thin situation where cash coming in goes right back out so that you can keep the doors open? As I mentioned before, our liability is increasing faster than assets. How dependent are you on future fundraising success? So are a lot of your functions really dependent on your fundraising? And as we all know, that can rise up and down depending on what's going on in the economy, local and national, what's going on within your organization, what's your reputation, have you had a lot of turnover in that function? Lots of things can happen in there. And then what financial risks concern management the most? What is management the most worried about? So these are questions your board can consider. Not that there aren't a million other questions to think about, but these are some. Okay, the next statement is the statement of activities. So the statement of activities looks at, in general, revenues and expenses. So we're seeing all the sources of revenue that a nonprofit organization will receive, and then all the expenses related to that. So on the revenue side, the presentation for an audit, a review, or a compilation is separating activity between donor restricted and unrestricted categories, which you may do internally as well. Some nonprofits, financial statements are fairly robust because they're very large, but if you're a smaller organization, you might not have that level of detail, or you might not maintain that level of detail within the books. You might be having a separate Excel schedule or something like that. So this statement provides insight into operational sustainability and financial performance. So what does that mean? So that means, are the revenues coming in substantial enough to basically pay your expenses and you're ending up with a surplus at the end? So are you generating revenue that's not only going to pay current expenses, but are you also building additional dollars for the future? On the revenue section, it highlights funding diversity and revenue concentration risk. So funding diversity is, how many sources of revenue do you have? Are you an entity that has contribution revenue, program service revenue, investment revenue? Do you have other income coming in? Do you sell goods? Are there lots of different things happening, so you're not overly reliant on just one source, which is the concentration risk. So organizations that are very contribution focused, they're relying on one source. And if things go down, it could be very dicey for them. So diversifying your funding sources is really important if that's possible for you to do. And then finally, it shows whether the organization has generated a surplus or a deficit. So on the revenue analysis, I talked about that a little bit. As we all know, contribution revenue can fluctuate sharply with economic conditions and your donor's behavior. That's why it's always important to maintain those relationships, but also grow those relationships. I think in Madison, we're very fortunate. It's a very philanthropic community where we all know that people do donate quite a bit of money. And there's certain people that have donated a lot over the years that are aging. And it's always important to remember, like, who is your population of donors and where are they at in their careers or their lives? And what are you looking at as far as future and developing new donors? That's always critical as well. The grant funding you receive, if you're an entity that does receive that, may have restrictions or renewal uncertainty, or may just disappear. Maybe the grant funding just ends, or so that's always a consideration too. Program service revenue. So this is the revenue that you charge your constituents, your people that you serve, and how that comes in and then supports all the expenses that are related to that. Because program service revenue should really help drive how much you spend as well. It should cover those expenses to make sure you can provide services for those that need it. And then also, but not to the detriment of the organization where you're putting yourself in the hole financially. Investment income can introduce volatility into the operating results, meaning that if there's a bad period in the market, it can drive the investment balances down as well as the returns. You can also have the positive side of that. And then, as I mentioned before, it's very important, if possible, to diversify your revenue streams, always looking for other sources of revenue to balance out so you're not over-reliant on one source. I know during COVID that many organizations looked for other funding sources because of what was going on and really, really really put a lot of effort into it, ended up in much more financially secure position than pre-COVID. And I've had a couple of people said to me, I wish we would have done this before because we were so successful at it. We should have been doing it all along, but live and learn. But the good thing about it is they found other sources of revenue that help them stay open. Now, on the other side of this are the expenses. So that's on the statement of activities still. So we're looking at program service expense management in general and fundraising. So the expense and operating trends we look at are the recurring operating deficit. So everything's in the negative all the time. So that can lead us down a path of looking at, will this organization survive? Would we have a going concern issue as the auditors, or internally, are you concerned that we just can't meet this budget anymore? And are we looking at changing what we do as an organization? So there's that strategic look at what's happening. Sometimes you can have rapid expense growth without the matching revenue. That can be concerning, but if you've planned for it, because you're going to go into a new programming, or maybe you're going to do a new direction, but you've built up reserves to pay for that until the revenue finally follows, that can work. It's going back to what is your strategic plan. But having expense growth because in general expenses are much higher and that revenue isn't matching that, that would be a concern. The expenses can be distorted by one-time gifts or investment gains. So for example, kind of going back to revenue, we've had several clients who've gotten very large bequests. So with a bequest, you don't know it's coming, basically. That's typically, you don't know. And I know I had one client that I got $1 million bequest that they weren't expecting, which was great. And at the meeting where we presented the audit, they were very clear with the board to remind them that this was an anomaly, not something that's going to come in every year. And same with investment gains. You can have a very good year in the market, and it makes it look like the financial statements are great, which they are, but it's not from driving your revenue and expenses of your normal day-to-day operations. Also, with the statement of activities, here's where you're looking to budget to actual and comparing what did you budget versus what is actually happening. And that's always important to look at pretty much constantly. And then recurring versus non-recurring expenses. So for example, your recurring expenses are your utilities and your salaries and all those things that happen every day, every month, every year, versus a non-recurring. So say in the Madison area this spring, unfortunately, we've had a lot of storm damage. And do you have a significant amount of damage to your building, or to say you have vehicles that were caught that aren't all covered by insurance, and you still have a large amount you have to pay? So looking at those two types of expenses. So that's where you're really looking at what is happening within my financial statements, and why do I have anomalies that I need to explain to the board, or that I need to account for, or develop a plan to address, so we don't put ourselves in a financial situation that's not positive.
So, Kirsten, you talked about
Yes.
not putting yourself in a financial situation that's not positive. You
Right.
are seeing financial statements every day. Just off the top of your head, what are those trends where it's these are the main challenges for organizations right now? Like, what are you seeing out in the marketplace?
Well, unfortunately, some people who have a large component of federal grants, federal awards, and that is their revenue source, some of those have been taken away. We do have several organizations that are having to consider ending and closing their doors. So that is not good to see. So that's what I'm seeing. But I'm also seeing, again, Madison's a very philanthropic community. So I really see people, kind of raising the bar and really supporting their organizations that they're involved with. But that goes to a very robust like communication development strategy and the nonprofit itself being very focused on these financials and where things are going and trying to address concerns in advance. And then also looking at what they're doing. I I know for a lot of people, I think think of COVID was a long time ago, but I just remember going to a lot of galas and a lot of events before that happened. And some of those have come back, but a lot haven't because people are like, that was a lot of work and we really didn't, it's great reputationally. Everybody has a great time, but maybe we didn't raise enough money to really justify all that work that went into. So I think people are redirecting how they spend money on fundraising and donor relations and things like that, and realizing that maybe more one-on-one relationships with their donors might be a better way to go than a gala that is great and fun, but is a lot of work and might not give you what the end goal really was. So I think people are really reassessing what's happening because it's very evolving and ever changing right now. It always has been. I feel like everything's kind of sped up and changing rapidly all the time. People are very busy.
People are very busy.
Yeah.
You talked about the federal funding in a lot of different areas going away, but that is coinciding with a market that seems to be doing pretty well. So I think some of that philanthropy that people or that organizations are leaning on is still there.
Right.
What happens when the market is not doing as well and there's still no or less federal funding? What do you suggest to organizations who could envision that happening on the horizon?
And that did happen to people, 5 years ago, where they started looking for other grant sources. So people applied for grants they never would have applied for, kind of in that thought of like, oh, we're never going to get this, so why bother? But then it was a situation of like, well, nobody's, we're back in COVID and nobody's working, and people are like, I can't donate right now. So they went the route of where are their funding? So they went on a search basically. So they really worked on diversifying the revenue streams, and that's what you really need to do. But for those of you really contribution heavy, I would just continue to really hone in on those relationships with your donors and expanding that base, because it's very easy to have aging donors that are still very supportive of the organization, but you've got to cultivate all those new people as well. Because Madison's also a very financial, and I know in Wisconsin and in general, wherever people are listening from, different communities are very wealthy in their own way and can support a lot. And it's always good to be doing outreach to those communities. But I think looking for other sources, got to get creative and think about what other avenues are available to us. So this is a whole other grant situation out there that we could look into that we just haven't done before. So you got to get creative with your board and management and have people kind of all in the same, swimming in the same direction. I always think of that fish. All the fish are swimming in the direction of the big fish. All right, so next is statement of functional expenses. So this supports the statement of activity. So when you're thinking about how you present your financials, or for those of you who have an audit and you look at the statement of activities, you have program service activities, which could be divided into, say, you have education, you have training, you have a specific program, like you have a food pantry, things like that. And those expenses are big lump sum numbers on your statement of activities, as are management in general and fundraising. The statement of functional expense then breaks those numbers down. So in other words, you're sitting there thinking, what makes up this $2 million total for this program that we run? Statement of functional expenses shows you all that detail. So it's salaries, utilities, payroll taxes, depreciation, training, whatever you do, it gives you that level of detail. And I think this statement's really important. I think it's really helpful for the board members, especially because they can see the detail of what goes into those big numbers. And then they can also really see, like, salary wise, that there's big numbers involved, for certain organizations going into those totals, whether it's program management in general or fundraising. So the second bullet point, providing transparency into how resources support mission delivery, that's really your program service activities. So how do the resources you're using, so the people mainly, support the mission? And you can see those numbers. Things to look at in the statement of functional expenses, and even that feed up into the statement of activities, are allocation methodologies. So this is really important. I'll go into this later too, but how you allocate expenses. So some people might be program people. They work on programs. That's what they do. So 100% of their salary, their benefits, their taxes would all go to program service expense. Other people might be spread over the three areas. They might do a little program work. They might be more management in general. I'm thinking, say, of an executive director, and they might do a little fundraising. So their time needs to be allocated. And so then they would keep track of their time basically, and you would allocate their salaries accordingly. Just like some expenses might be unique to only programs. So say you have a food pantry, if you're buying food for that food pantry, that's a program service expense. That doesn't get allocated. But if you have utilities and you're lighting the entire building and people are working in different areas, then typically people will use square footage or some type of methodology like that. But it just needs to be reasonable. You need to document it and you need to be consistent. And your donors and watchdog organizations will look at that, those that are sophisticated and understand what they are looking at. And I think we have another poll coming up, and we'll go through that. So the question is, how confident are you that your organization's expense allocations are reasonable and well documented? So again, we have very confident, mostly confident, somewhat uncertain, not confident, and unsure, or I have no idea. I'll say, and we'll talk about this soon, but reasonable is a confusing term at times. Well documented shouldn't be, but reasonable is kind of like common sense. You know, what makes sense for the organization. And then the documentation is actually writing down what you do, putting that into a document so that, say, I was there and I know what I do and I've documented it. So I leave tomorrow, then the person after me knows exactly what to do. So that's why that's so important. And we should have our answer coming up here pretty quick. Oh, that's great to see. So most people are very confident and mostly confident about their allocations, with some of you being a little bit uncertain and just 4% of you being not confident. But that's where we're going to talk about next. So you can be more confident and understand what's happening. So red flags in key consideration, sorry. So in the functional expenses, balance is the goal. So you want to look at overall how you're allocating costs and what things look like. So you want to make sure you're obviously delivering on mission, but there is costs with administrative services and fundraising. So there is the thing that goes around about how we can't spend too much money on admin expenses, but too much is who knows what that means. You need to spend what it costs. You need to support compliance, governance, cybersecurity, HR, internal controls, whatever it may be. I mean, admin is important. It's like the underlying glue that helps run the organization. So it's really important that money is spent in that area. And I know people try to focus on targets of spending, which is important, but you really need to assess what does it take to run this organization that's outside of program and fundraising. So that's where point number 3 comes into play, where you say lean does not equal healthy. So overemphasizing program over admin and maybe cutting some of those areas short may be a good short-term fix to put more money into programming, but may create risks down the road, and risks as far as internal controls failing, the opportunity for theft to occur, that kind of thing. And then this is what I mentioned earlier. So fundraising as an investment. So you're looking at your fundraising and what you're doing. So are you getting a return on investment? If you're doing those big events, does that make sense for you anymore? Is that something that's kind of gone the way of the past, and it's better to refocus those dollars in a different amount to really focus on donor growth and retention and developing new donors? One thing that we always like to do as human beings is compare ourselves to others. So when you're looking at comparisons of yourself to what you would consider to be a peer organization, you need to be really careful with that. No two nonprofit organizations are alike, even if they're in the same community. So I'm gonna mention like a Habitat for Humanity. If the one here in Dane County is different from the one that's, say, in Minnesota, that'd be different to the one in Iowa, or it would be different to another one in Wisconsin. So you have to be careful what you're looking at, because everybody's operating in a different community, different regions. They have different goals. They might have completely different strategic plans depending on the people they serve. So you have to be aware of that and be careful what you're looking at. And even salary-wise, an executive director might be paid much more in one area than another person, but that can all be cost of living and other reasons that aren't even known to you. So you have to be really careful when you look at those. And then we look forward to also red flags and functional expenses. So some of the red flags that come up are that, as I mentioned before, aggressive allocation of cost to programs. So everything's a program expense, nothing goes to admin, nothing goes to fundraising. And that's actually not realistic. I mean, that would be a red flag to me. I would see that and say, well, it looks like they're overloading the programs with costs. And that may be because you're trying to spend all the dollars you got from a grant, but it's where you look at your grant funding and other funding that you're getting. If there are requirements on how you spend it. Typically in those requirements are allocations for admin costs and fundraising costs and things like that. If the allocations are changing year by year with no explanation, documentation, that would be an issue as well. So in other words, things are just changing and nobody really knows why. Somebody knows why, but not everybody knows why. And that goes with the last bullet point here too, allocation methodologies that shift throughout the year. Now, this can all be fine. There can be valid reasons for why this happens, but the key is documentation and explanation so that everybody knows why. You may have people that switch their roles. They may have been really program focused, but now are more fundraising focused. So you see salary shifting, but that methodology should be the same. That's tracking hours. So even though people shift and things change, that happens. But the key is when you make changes to document it. But consistency is actually very important. So think carefully before we start shifting things around. The flip side of that is if you have rapid administrative cost growth, but there's no reason for it. So are you adding a lot of admin type people because maybe that's what a specific executive director prefers, but we're not bringing in the revenue to support those positions and at the detriment to the programming? Is that taking away from programming? So you need to justify why people are being added, how they're going to be paid for, where's that revenue coming from, and what they do in the organization. This is kind of an admin cost as well, minimal investment in finance or compliance. So in other words, we're shortchanging possibly our accounting department. We don't have either the right person at the helm that maybe is a CPA or has years of experience in accounting or is an accounting major, or it's just one person and they really need to have three people in that function. So you don't want to, I see that a lot. It's far less so than when I started in public accounting almost 30 years ago, which I can't believe. But I used to see that there'd be that one person doing the books of the organization that only has that job by default because nobody else would take it. Fortunately, I don't see that anymore, which is great. But I do see people being more robust and building out their accounting departments, or they're using a third-party service, which actually is really helpful too. And then looking at high fundraising costs, but you don't have any contribution revenue. That's where you really have to assess what you're doing while you're spending those dollars. If they're not providing you with anything, you're better off saving the dollars until you can redirect and figure out which one to do. So moving along, we have our final statement. I think there's a slide. I think we're on the right side. That looks right. Okay. Statement of cash flow. So this is a statement that even we as auditors, when we present to the boards, kind of zoom right through it because it is confusing. It's a confusing statement, but it does explain actual cash inflows and outflows. So you're seeing how cash was used or provided through operating, investing, and financing activities. And how cash is provided, a perfect example is your receivable balance going down? That means cash is coming in, receivables are going down. So if you're getting multi-year grants, those dollars are coming in. That's a provided. Used in is when you're paying your expenses. That's the easiest way to look at it. Investing activities include buying property, plant, equipment, and also selling it, or buying investments and also selling investments. And then financing is your debt and also leases. So the cash flow statement gives you an idea into liquidity and, again, operation sustainability, because at the end of your statement, it gives you the ending cash balance that then agrees back to the cash balance on the statement of financial position. And if you see those numbers dropping year over year, you know you're having a problem with liquidity. You just don't have enough cash. The last bullet point, accrual-based surpluses do not always translate into positive cash flow. So an accrual-based surplus, you're probably sitting there thinking, what is that? I have no idea. I'll go back to the pledge receivable example. So say you have a donor that's giving you $1 million, but it's going to be $200,000 over 5 years, starting in 2027. Well, you know about it today on May 28th, 2026. So you're required to record that entire amount into your financial statements. So you're required to record a pledge receivable for $1 million and revenue for $1 million. So that makes the statements look very robust, very healthy, or maybe it plugs up a hole where things weren't looking so good. But the issue is that is not cash. So if you're having cash flow issues, it's great to have that. You'll have cash in the future, but it's not giving you cash today. So that's what that is saying. And I like to explain that because it sounds very accounting to me, like accounting terminology, not just my day to day and what am I doing. So looking at cash flow, as I said before, if you look at operating, that's what you're using day to day. You're getting your receivables in, you're paying your payables, other liabilities, and I'll let you read through that. But it's just looking at, does our cash provide support for us to run our day to day? Investing is cash for the future, excuse me, and financing is cash from outside, so debt. And so those are the components. All of you that have reviewed or audited or even compiled financial statements and you have presentations by your CPA firm, if you want more information when they're presenting, just ask them to go through it in detail with you. It can be a little confusing. It might be better for a one-on-one conversation, but it's important to understand what this is telling you. Okay, so now we are at to how do these statements connect with each other? And in many ways, but I will just go through some things, how they're interconnected here. So statement of activities are your operating results. Remember, it's the revenues less the expenses, and that gives you a positive or a negative. So if you have a positive, it's an operating surplus, and it increases your net assets without restrictions on the statement of financial position. So in other words, now there's more dollars available to the organization to spend on program management in general and fundraising, or for the future. Changes in your receivable balances or your payables impact operating cash flow. So you're looking at your statement of financial position and your cash flow statement. So if your receivables go down, that means you're collecting cash, which improves your cash flow statement. If your payables are going down, same thing in a way, but you're spending cash means your cash flow statement, you're using that cash in the cash flow statement. So with these receivables, payables, and other things on the cash flow statement, this is where it gets confusing because they're going up and down. There's negatives and positives, and it can be confusing, but you have to think about what those balances are doing. If your payable balance is increasing, that means it has a positive effect on cash flow because you're not paying your balances. So the cash is not going out the door. So you can kind of see the confusion there. Restricted contributions improve net asset balances but may not support operations. So again, if I give you $100,000, but I say you have to spend it on a specific program, that doesn't mean you're going to be able to spend it just to support operations. For those of you with assets that depreciate over time, that is an expense item on the statement of activities that results, but it's a non-cash item. So it does go into the cash flow statement and affects that balance, but it's a non-cash item. So another level of detail that can be confusing for readers of the financial statements. And then finally, debt financing can give you short-term liquidity. You've got some cash in from a line of credit or you took out a short-term loan, but now you've increased your debt and you have a future obligation that you will have to pay back. So you can see that these dollar amounts are flowing through all these statements at a certain point in time. And when you understand that, then you're really understanding what's going on within the statements. Okay, we have another poll, and that should pop up here. How engaged is your board in financial discussions? Highly engaged, moderately engaged, minimally engaged, mostly reactive, unsure. Hopefully highly engaged, but we'll see. Or mostly. Hoping you all have highly engaged boards, ask really good questions. Okay. Oh, well, we have minimally engaged boards. We have a lot of those, moderately engaged, and not so many highly engaged. I think my recommendation on that is to talk to them about where the gaps are, because it sounds like a lot of people need some training to understand what they're looking at. And that's probably why they're not that engaged, or maybe don't see the financials very often. That's another thing to consider. If you have boards that meet quarterly or biannually, it's a minimal opportunity to see the financial information. So that could explain the engagement. In that case, you need to provide complete financial statements every single time. Same with monthly meetings. I mean, you need to make that a component part of your board meetings.
Kirsten, I wonder what the
Yeah.
results would have been if we had an option in there for too engaged.
Well, maybe that's the highly engaged.
Maybe that's it. Maybe that's how they answered.
Yeah. Yeah, but I with that, because I've seen where we've presented, nobody asked the question, which is a little terrifying. But no, it's important for them to feel comfortable to ask questions and not be afraid to say, I don't know. I know you've told me this 7 times, but I still don't understand it. So it has to be a also a culture of openness and that it's fine to ask questions and it's fine to ask for a one-on-one meeting to understand what the numbers mean and make that just an important thing that you push out as management and equally as your fellow board members to encourage people to ask questions because they do have a fiduciary responsibility. They are directly responsible for those financial statements, so they should understand what they're looking at. One thing to talk about too, especially for those of you that have audited, compiled, or reviewed financial statements, are the footnotes. So you're not necessarily going to create footnotes for yourself every month, quarter internally. You might, some organizations do, a lot do not because you just don't have that capability or the time involved. But with those types of engagements, audit, review, or compilation, we work with you on the footnotes. So there's many different disclosures. There's the Note A disclosure, which is the nature of the business of the organization and all your accounting policies. And then there are all the footnotes that support the dollars on the statement of financial position. They can support the revenue dollars and give a lot of transparency, a lot of information to the readers of the financial statements. One of the things that are one of the very last footnotes is where we put it as SVA is the liquidity disclosure, showing you how much cash is available to support operations within 1 year of the balance sheet date. So we take the cash, the receivables, the investments, subtract off any restrictions or any reserve balances to let you know how much cash is available. And we do have some clients where that number is negative. So that's an area of concern right off the bat. Also, if you do have debt or lease obligations, there are extensive footnotes that talk about that, especially with debt and leases talking about terms and future payments that are coming up. Concentration disclosures here, this is really important. Some organizations have donors or customers or geographical concentrations that could make things really difficult if those donors disappeared, your customers dwindled, that kind of thing. And then occasionally there's a subsequent event footnote, which are things that happen from the balance sheet date, so your year end, so say your December year end, to the date that we would issue the financial statement, say it's an audit. So sometimes that might be 6 months later. So things can happen. You may take on debt, you might start a capital campaign, you might decide that you're going to dissolve your organization. There's lots of different things that can happen that need a short disclosure in the financial statements to make the users aware that there's a subsequent event that happened that will affect the current fiscal or calendar year that you are in. But I'll say in the Note A financials with the accounting policy and the nature of business, this is where you can really talk a lot about what you do as an organization. We have footnotes on revenue recognition as well. That's something that came into play, was significantly revised a few years back. And that some of our clients really use that to talk about their programs and how they're generating revenue for each program, what those programs do. So in addition to your 990, which is people really see as the public document where you can add a lot of detail. You can also do that in the financial statements and work with your provider on that. And then now we're looking at, okay, what do I do? I have all this information. How do I review these financial statements? Review them together and start looking at things and how things flow together. Like as my receivable balances go down, my cash is going up. As I record revenue from actual dollars coming in, or if it's receivables where I'm recording revenue, how does that affect things? Looking at that cash flow, how is my cash flow looking? Do I know that I've got cash that could cover multiple years? And then maybe I should look at that cash and should I create investment accounts? Also look at current results to budget and to prior years. That's always critical, but always realizing, especially looking at a budget is made in a vacuum at a certain point in time and things change, things may happen. So knowing why, if you've got something that's doesn't compare to your budget, is very high or very low, what are the reasons behind that? Same with prior years. Prior year comparisons can be a little misleading in the sense that things may be changing rapidly in the sector you're working in or in your community, and things could vary widely between years just depending on what's happening. But again, knowing what's happening is the key. Use of dashboards and trend analysis between periods is very helpful, especially in the revenue side, but then also expenses, key expenses. Why are my salaries trending up, but yet we have less people? Does that make sense? Or have we hired a lot of people, but yet program service revenue is going down? Looking at those trends and seeing how one decision impacts other decisions that you're making. And then as I was just saying, within the accounting group, within management, with the board, encouraging active discussion and questioning. And then looking overall at all the financial decisions you're making. Does it follow your strategic plan? Is it time to revise the strategic plan and go into that? Make sure that you're aligning with what you said your goals were to begin with and not getting off track and having that mission creep where now we don't even do what we said we were going to do, and looking at that as well. And then finally, trend analysis and oversight. So looking at different trends going on with the financials, which we talked about a bit. It is good to look at 3 to 5 years of financial information, and there's plenty of software out there, including AI, that can help with putting together that type of information very quickly to help you look at things. I would definitely monitor trends in net assets with and without donor restrictions. Are so many of your donors restricting dollars that now you have nothing left for operations? We actually had that years ago where a lot of the arts organizations ended up having a lot of restricted assets and not a lot of unrestricted. They were struggling. There basically wasn't enough cash available just to pay for operations. Look at your reserve levels and your liquidity needs. Do you need to move dollars out of reserve or into reserve because you've got a lot of cash or not enough cash? Always look at how dependent are you on a major donor or a grant or major donors. Again, going back to diversification of revenue and making sure you've got a lot of sources coming in. And then that again goes with working with relationships with people. Looking at your staff growth alongside your program expansion, does that make sense? Are you short with staff? Do you need more people or do you need less people? Did the program not expand like you thought it would, or did it not take that many people to accomplish the goals? And then look at your recurring operational deficits if you have that. So is it month over month you're in the red? Is it year after year? Because that will signal a problem that will you ultimately have to shut your doors because you are become what we call a going concern. So it's really important to keep an eye on these things as in addition to, I know everything else you have to do on day to day to put everything together, but to monitor these trends over time is very important. And then questions your boards or stakeholders should ask, and there are many questions they should ask. These 5 are hardly the start of it, but and they should be asking management or the accounting group, whoever the representatives are, and asking what assumptions drove the budget and financial forecast. So what were the people thinking when they put the budget together? What are the things that they know that maybe the board doesn't know? What would happen if you lost a major donor or a major grant? Is that going to be such a significant impact that you aren't going to be able to stay open, or you would have to downsize, whatever that would mean to you? Are internal controls evolving with organizational growth? So are you expanding so much that now things are a little bit loose? It'd be really easy for a theft to occur. Really assessing that on basically a very ongoing basis, making sure you've got controls in place. One thing that happened again during COVID, which I know if that drives people crazy, I'm sorry to keep mentioning, but when one person would go into the office, they would deal with everything. And so basically people destroyed their internal control structure because all the people who are involved in the internal control structure were at home. And this is really kind of over the cash receipts function and making bank deposits and things like that. I know many more things are electronic now, so that's less of an issue, but that does happen. What financial risks are not obvious from the statements alone, because there could be risks in the organization that aren't financial in nature. Ultimately, they will be, but there could be things going on that need to be known by the board that maybe haven't been communicated. And then how does management think, or what does financial sustainability mean to management? What does that mean? Does that mean that they can pay the expenses 5 times over? Does that mean that they have a very robust investment balance? What does that mean to them? And those are important things to talk about when you are a board member or a stakeholder that's looking at a large investment within the organization. And then finally, this is our last poll, and we will see what that is. And based on all this information, I know it's a lot in 50 minutes, 60 minutes, but what area do you plan to focus on more after today's webinar? So is it liquidity and reserves, revenue diversification, cash flow analysis, functional expense allocation, board financial oversight, and trend analysis? Or maybe all of the above. We don't have that option. Maybe we should. And we'll see what everybody has to say in just a second here. Okay, this should be popping up. All right. Board financial oversight and cash flow analysis. I think those are great areas to focus on. I can't stress the board being involved, but being knowledgeable enough. That is really important. Those people are there to help you and they should be utilized for sure. And then cash flow analysis, always looking at where you're at with cash and when you expect dollars to come in and if you should be looking for other revenue sources. It's always very important to keep the doors open and keep you doing what you need to be doing, which is your mission and helping people. So in final takeaways, no single financial statement tells the complete story. We know that by now. As you guys all realize too, liquidity, sustainability, and mission impact are interconnected. Looking at trends is important, strong governance is important, and then financial oversight to make sure that you stay in business doing what you do and then also support long-term mission success.
Kirsten, that was a lot.
That was a
That was
lot.
a lot to cover. That was a lot to cover. Well, the plan was to save some time for questions. We there was just too much to cover, but it was good. That was really good. Thank you for that. We did get a few questions that came in. Can you just I'm going to kind of summarize a couple of them. You talked a lot about trends
Right.
and red flags. Can you talk about kind of if you do receive an audit, what's your CPA firm's role in identifying that? Like how much of a role would we typically play as an auditor to sort of be pointing these things out?
Yeah, so our main thing is looking at that cash flow and looking if revenue is trending downwards and cash is trending downwards, we're seeing deficits. Because one of the things we do as auditors is to see if there's a going concern issue. So what that means is that will the organization be able to sustain itself for another year from its last year end? And if that answer is no, then we put what we call a modification to the auditor's opinion that there is a going concern issue. We've also put in a footnote and describe what management's plan is to try to alleviate that and keep themselves running. That's one of the things we look at. So we look at revenue, we look at cash flows, we look at things trending down, and we also look at our receivables really high, they're not getting collected. Are there too many net assets with restrictions? Is that a very high balance? So we're looking at what's going into cash and cash flow to support the organization. There's a lot of things we end up looking at to come to the decision that really the organization is viable and will continue, because otherwise we have to go down the going concern path.
Right. Okay. Well,
And it
and
doesn't happen that often, actually, the going concern piece, but it is out there. It does happen.
yeah. And we just had another question come in about like dashboards. I think we can reach out to you folks individually with some insights there. Knowing that we're
Definitely.
over time, I want to wrap up. Kirsten, thank you so much for all of that. I know how much everybody appreciates it, and just your wealth of knowledge is awesome. It's just
Thank you.
it just can't be compared. So thank you for that. And again, if you do have questions, either reach out to Kirsten or I. We can make sure to get back to you.
Definitely.
Um, yeah, as a reminder, you can visit svaaccountants.com to access past webinars and articles, podcasts, additional nonprofit resources. Scan the QR code on your screen right now to sign up for our next webinar in September. This one is titled Beyond the Statements, Footnotes Form 990, and What Reviewers Look For. And I just would encourage you all to connect with us if your organization has any needs. If an audit, financial statement review, tax, compliance, outsourced accounting, any type of advisory or strategic consulting or board training, we do all of that, and we'd love to talk to you about how we can help your organization. So if you're already an SVA client, please reach out to your SVA team if you have any additional questions or if you haven't put them in yet. But if you're not a client, please reach out to Kirsten or I, and we can make sure to answer those questions. We'd love the opportunity to connect with you all. Thanks again for attending today. Hope you all enjoyed it and have a wonderful rest of your day. Bye-bye.
Thank you, everyone.